Boom, baby. Alright, this video is going to be on debit spreads, how to do them. I'm going to show you guys how to do it on your brokerage. It's an options trading strategy that I use a lot. So what is a debit spread? It's basically just an option strategy, and it's a way to get closer to the money and spend less by financing your other option. So this is just one of my Instagram posts that I made a while ago. You can pause the screen and screenshot this to get an overview of what debit spreads are. Alright, so this is how you would set up a debit spread on Tastyworks. This is what I usually use for trading options. So let's just go to Facebook and just pick any expiration date. So let's say by June 19th, I think that Facebook will go to or above $240 a share. So I could buy this call contract for $235. That's the debit. And then I usually don't spend that much on a contract. So what I could do is I can then sell this one right below it to finance the first one. And what that does is it lowers my cost. So now it's a 49 debit instead of a 230 or whatever the fuck it was earlier. So like what this means is that you're buying a long contract and then you're selling a short contract right below it to finance the long contract. So you're buying 100 shares and then selling 100 shares for a cheaper price. So it's best used if you want to get closer to the money or you don't want to spend as much, and then with Tasty you can just keep scrolling down. So the thing with that first one, we look at it 240. The spread here is $2.50, which means times that by 100 you have a $250 max gain. So with a normal naked contract you have an unlimited gain and a defined risk, but with debit spreads you would have a defined gain and a defined risk. So that's like the only downside to it, but if we can see here, we can move this one down to here. Now it's a $500 max gain and we're only spending $1.17. Or we can go down even farther. This is a $1,500 max gain and we're spending $50. So if I thought that by June 19th Facebook would go to 250 or past 265, which is my short position, that would be a $1,500 max gain, and I would be buying it for 60 cents pretty much. So it's a great way to get closer to the money and spend less. Alright, so just to do one more example here, we have Tesla. Let's go all the way down to September 18th, 2020. So let's do this on the put side. So the stock is currently trading at $805. Holy shit, their implied volatility is high. Alright, so let's say I think by September 18th Tesla is going to go to $620. So I would buy that one, and Jesus fuck, I would have to spend damn near $4,000 for that put contract. I don't do that. Fuck that. So what I could do is I could then sell this one, and that turns it into $1.27. So as you can see here, the percentage of profit probability is 33%. So this honestly isn't that bad of a trade. I like this one. I'm not really bearish on Tesla though, but that's just the concept of it. You can do it on the call and put side, and you're also, it's not really selling premium. That would be a credit spread. I can do that in a different video, but it's a long position and you're just financing it with the short contract. So this one right here would have a $500 max gain because 620 and 615 has a $5 gap, which means times that by 100, $500. And then so you would have a $500 max gain minus how much you spend, so $1.27. So your max loss is $127 and your max profit would be $375. The market's open right now, so that's why all these numbers are changing, but that's the idea of it, and I use this a lot all the time. Alright, so this is going to be an example on how to do it on Robinhood, because I know a lot of people use that. So AMD, for example, go to trade options. We're just going to pick our expiration date, June 19th. So if we're bullish on it, we're gonna buy a call, let's say the $55 call, and then we're gonna go to sell and hit 56. So that way we're financing it, and it's a total cost of 30 cents instead of a dollar, whatever it was before. So the thing you have to be careful with is you have to make sure you're selling that second contract after your long contract farther out of the money than your long contract. So on Robinhood, on the call side, it's above it, or you get what I'm saying. But if you sell it closer below your long contract, that turns it into a credit spread, and you will receive a credit instead of paying a debit. And that's the complete opposite of the play you're most likely trying to do, and you would lose a lot of money. So just be careful, do it right. You know what the fuck to do, man. Come on, give me something. I'm a small YouTuber. Just like the video, subscribe. Come on, do it.